It's 7:14 on a Tuesday morning in München. You're sitting at the kitchen table, coffee going cold, staring at your phone. A colleague sent a message in the WhatsApp group last night. He bought Bitcoin 2 years ago and just sold half his position. The number he typed looks wrong. You read it 3 times. It isn't wrong. And now you're doing that thing everyone does in this moment. You're asking 2 questions at exactly the same time. The first is, did I miss something enormous? The second is, do I actually understand this well enough to put my own money in? Most Germans have heard the word Bitcoin 1,000 times. But the second you ask them to explain how it actually works, they go quiet. By the end of this video, you'll understand what Bitcoin actually is, how crypto works inside Germany's specific financial and tax framework, what the Finanzamt expects from you, and whether any of this has a place in a serious German wealth-building plan. Rewind to 2008. The global financial system was imploding. Banks were collapsing across the US and Europe. Governments were printing money at a scale never seen before. Ordinary people were watching their savings, their pension assumptions, and their sense of security dissolve in the middle of that chaos. Someone using the name Satoshi Nakamoto published a 9-page paper online. The idea was simple but radical. What if there was digital money that didn't need a bank, a government, or any middleman at all? What if trust could be built into the code itself? A year later, in 2009, Bitcoin was born. 16 years on, 1 Bitcoin trades for tens of thousands of euro. What started as a strange internet experiment that established banks dismissed as a curiosity is now held by major institutional fund managers, publicly listed companies, and even certain government treasuries. So what is Bitcoin? Strip away the buzzwords and it's digital money. The difference is in how it works. Picture a giant public ledger that every person on the planet can read. Every time someone sends Bitcoin to someone else, that transaction gets written into the ledger. The ledger is copied simultaneously across tens of thousands of computers around the world. And once something is written, it cannot be erased or changed. That ledger is called the blockchain. It runs on mathematics and code, 24 hours a day, 7 days a week, with no Feiertage, no Öffnungszeiten, no closing time. While Frankfurt sleeps, the network is still running in Singapore, in Sao Paulo, in Chicago. It never stops, it never asks permission, and nobody has the authority to switch it off. New Bitcoin gets created through a process called mining. Powerful computers around the world compete to solve complex mathematical puzzles, and the winner receives brand new Bitcoin as a reward. But here is the detail that changes everything. There will only ever be 21 million Bitcoin in existence. No central bank can print more. No Bundestag vote can create extra supply. That built-in scarcity is exactly why a growing number of German investors have started treating Bitcoin like digital gold. A store of value in a world where every major currency has been expanded aggressively over the past 15 years. Every 4 years, an event called the halving cuts the new supply of Bitcoin entering the market in half. The most recent halving happened in April 2024. Historically, these events have been followed by significant price movements. The logic is straightforward. Less new Bitcoin is being created, but demand continues, so price tends to move upward. The next halving is expected around April 2028. It's also worth knowing that Bitcoin is not the same as crypto. Bitcoin is one specific asset with a fixed supply and a single purpose. A form of digital money that operates without central authority. Other cryptocurrencies, Ethereum, Solana, and thousands of smaller tokens, do very different things, from powering smart contracts to running decentralized applications. Most carry far higher risk than Bitcoin itself, and a significant number have gone to zero entirely. Knowing the difference is the first line of defense against losing money. In Germany, Bitcoin and crypto are completely legal. You can buy it, sell it, hold it, and in a growing number of cases, use it directly. The most common entry point is a regulated crypto exchange. A reputable platform lets you sign up, complete identity verification under the standard KYC process, connect your German bank account, and purchase Bitcoin in minutes. What you should look for is whether the platform is regulated by BaFin, the Bundesanstalt für Finanzdienstleistungsaufsicht, Germany's federal financial supervisory authority. Since the EU's markets in crypto assets regulation, known as MiCA, came into full force across all member states, Crypto service providers operating in Germany must be either BaFin licensed or passporting from another EU regulator. For everyday investors, this matters because it means stronger protections for your assets, clearer rules if something goes wrong, and tighter standards on how platforms hold your funds. For those who would prefer to avoid a crypto exchange entirely, there is another route that has grown significantly in recent years. Bitcoin exchange-traded products available on German and European regulated markets. Instruments like Bitcoin ETPs listed on exchanges such as Xetra or traded through European providers give you Bitcoin exposure through a regular brokerage account, the same account you might already use for buying shares in DAX companies or broad market ETFs. There is also a third path that more experienced Bitcoin holders take, called self-custody. This is where Bitcoin gets moved off the exchange and into a personal hardware wallet, a small device roughly the size of a USB drive. The reasoning matters. If an exchange becomes insolvent, assets held on it can be frozen or lost. Self-custody puts the holder in complete control. But it also places complete responsibility on their shoulders. If the device is lost and the recovery phrase is gone, the Bitcoin is gone with it. Permanently. Now for the part most people get wrong. And in Germany, getting this wrong can cost you thousands of euro. Tax. The Finanzamt does not treat Bitcoin as a currency. It treats crypto as a private asset, ein Privatsverwässerungsgeschaft, which has very specific implications under German tax law. Every time you sell Bitcoin, swap it for another cryptocurrency, or use it to pay for something, that is a taxable disposal event. This is where Germany's rules differ sharply from some other countries, and where the detail really matters. Here is the critical distinction that the headlines almost never explain properly. If you have held your Bitcoin for more than 12 months before selling, the entire gain is completely tax-free. 0. You owe nothing, regardless of the profit. Now do the math on this with me. Imagine you bought 10,000 euro worth of Bitcoin in January 2023, and it grew to 35,000 euros by February 2025. That is a 25,000 euros gain. If you sold in January 2023 plus 13 months, so February 2024 or later, that 25,000 euro gain is entirely tax-free under current German law. If you had sold it after 11 months instead, you would owe income tax on the full 25,000 euro gain at your personal marginal rate, which for many working Germans sits between 30% and 42%, meaning a potential tax bill of 7,500 euros to 10,500 euros on that same gain. The difference between month 11 and month 13 is not small. It is potentially your entire profit. This is the insider detail that most casual crypto discussions in Germany miss entirely. The other thing to understand is that crypto-to-crypto swaps reset your holding period. If you hold Bitcoin for 10 months and then swap it into Ethereum, that swap is treated as a disposal. Your clock for the tax-free holding period resets to 0 on the new asset. The Finanzamt has been increasingly clear on this and has data-sharing agreements with major German and EU-based exchanges. They know what was bought, what was sold, and when. Keep clean, detailed records, every transaction, every date, every price in euro, and work with a steuerberater who has genuine experience with crypto taxation. This is not a part of your financial life you want to improvise. Now the risk, because this part matters as much as anything else. Bitcoin is volatile in a way that most traditional German investments simply are not. Drops of 20%, 30%, sometimes 50% within a matter of weeks are not unusual. They are part of its normal history. If watching a significant investment fall in half within months would be psychologically unbearable, this asset is not a fit, at least not in any meaningful size. There is also the risk of losing access entirely, through forgotten passwords, lost hardware wallets, or a recovery phrase that was never written down properly. Hundreds of millions of euro worth of Bitcoin are sitting on inaccessible devices right now, permanently out of reach. Then there is the fraud risk. Germany has seen a sharp rise in crypto scams, fake exchanges, fake influencer endorsements, and fake investment schemes promising guaranteed returns. Anyone in your DMs or inbox promising fixed returns on Bitcoin is running a scam. Full stop. So where does Bitcoin actually fit inside a serious German wealth-building plan? It should not be the foundation. The foundation for a German investor looks like this: a solid Notgroschen, an emergency reserve of 3 to 6 months of expenses, held in something like a Tagesgeldkonto with a reputable bank, high-interest consumer debt paid down,